All right, let's get back to the markets on this Friday morning. We've seen some positive action in the first couple of minutes, but for the week overall, at least for the U.S. markets, it's been a challenging one. The S&P 500 on pace for another losing week. Looks like the Dow could end up with its 8th losing week overall. Let's talk to Alan Nuckman a little bit more about the road ahead for stocks. He's chief market strategist at Bullseye Option. Al, nice to see you as always. How would you describe the mood of the markets right now?
Well, the mood right now, emotion is greater than the actual VIX, the actual volatility. So, it's very interesting that people are so worked up. Obviously, we've had a sell-off. It's down 15%, but we're up 25% last year in the S&P, and we were 100% off the COVID lows. So I think the emotion right now is much, much greater than the actual fear factor, and that's just a fact for whatever reason.
Well, it gets confusing, and I get this feedback from our audience, too, because everybody's got an opinion, and we're looking at those U.S. markets a little higher right now. And even I was reading a story from Bloomberg today, and it highlights the valuations for S&P companies. They're back to where they were in 2020. You look at technically stocks that have moved below their 200-day moving average, some encouraging signs there. And then I read the strategists who say, you know how long bear markets can last, so get ready for some more pain. So it can make your head spin.
Okay, first of all, to say we're in a bear market, that may be, overjudging it. We pulled back. We've seen the average pullback over the last 50 years has been about 14% from the top. Again, it's a profit-taking pullback. We're 4 months into this right now. But let's talk about the emotion and the fear. People right now are having problems, digesting all the information. But if you look at it right now, the VIX is under 30, okay? And it's about 30% off its highs from January. And each new low that the market's made, we've actually had a lower VIX. And we've actually had lower volume on these 4 major sell-offs in 2022. But more importantly than that, the same phenomenon happened into 2021, where we were hanging around this 30 level in the VIX, and we had these lower highs. So this has happened just last year, but I don't think people were as emotionally concerned about the market. But the last point I want to make is, going with the VIX right now is at 25 or so. It was at 85 in 2020. 85. Process that.
Yeah. So, and just to reiterate, that means to you?
Well, that means to me that there was much more actual volatility as a measurement based on the fear factor in 2020 than there is right now. The markets have been relatively calm. It's been a 7-week slide. Just a month and a half ago, it looked like the markets were going to recover and make an attempt on the highs. And for whatever reason, earnings came out outstanding, but the market just continued to drift lower and lower and lower. But there's so many positives. The major concern in America is that there are too many jobs and not enough people to fill them. To me, that's not a bad problem. Right now, the economic concern about raising rates, we know rates have to go up, and they were starting at 0. That's just reality. Okay, fair points there.
One of the things that people have been asking us about our options. So hang tight here for a second, Alan, because I know this is an area of your expertise, and we've had a lot of guests asking us about ways that they can generate some income while they're holding some of the hard-hit stocks in their portfolio, names they might want to hold for the long term. Here's a somewhat simplified explanation. It goes something like this. Say you own a stock and you're skeptical it's going to rise in the short term. You've got these call options, which can give an investor an opportunity to buy a stock at a later date. You, as the owner of a stock, you can sell call options, meaning you're selling the option to somebody else to buy your stock at a certain price in the future, above where it trades today is basically the option that you could choose to sell. Now, let's say you think the stock could get there someday, but not for a while. By selling call options, you can earn some money today while you're holding the stock. Now, if it does by chance go above the option price, you'll likely have to sell the stock, but you earn some money in the interim while you were waiting. And then if you're betting the stock will struggle for a while and it doesn't rise above that option price in the short term, then you've got this opportunity to make some money on the option premium, and then you still hold your stock for the long term. Alan Nuckman, is that a fair explainer?
You got it. Okay. It's that simple. So now what people are trying to do is generate some revenue. It's like having an apartment building and you're generating monthly revenue. What you do is you have the underlying anchor position, the stock you like, the stock you're going to hold. And if you want to generate some revenue on it, get some yield, you can sell some near-term options, let's say the June options, because they're about a month away, and you're taking advantage of the short-term option increase in volatility. You're getting some rental income by selling a higher strike price against your position. Now, the downside is if there's a major move, you stop making money between here and that upper strike price. So you're going to take in a little bit of premium. But the positive is that you're getting some money into your account that's going to lower your basis and get add some money and some revenue. And it's something that people do on a regular monthly basis to generate revenue. But understand the downside of it is if there's a big move and the stock spikes above that option that you sold, that covered call that you'd sold, then your stock's going to get taken away, and you make the difference between where your stock is in that strike price.
And it almost feels to me like, Alan, it's a great way to litmus test that stock. How much do I think this is a name that's going to be, worthy of holding over the long term? Because to your point, if it goes up, somebody might take it out of your hands.
Right, it could get taken away. Now, there's a corollary to this, and I don't want to get too deep in the weeds, but what we also talk about, it has the same risk profile as a covered call, is you can sell a cash secured put as a way to get into a stock at a lower price, a stock you want. Let me stress that, only a stock you want. This is something Warren Buffett does. Instead of putting a limit order down below, if you want to buy a stock at a lower level, you could sell a cash secured put on that stock, and you'll be assigned that stock at a lower level if it goes down. And if it doesn't, you get to keep the premium. So it's a win-win situation. Either you get paid, either you buy a stock you want at a lower price, or you get paid not to. So there are a lot of great option strategies that take advantage of what's going on. So as I always say, there's always opportunity. Don't be wound up about thinking the markets are good or bad. The markets are. You have to use whatever tools you have to make money in all environments.
Good to get your perspective as always. Thanks a lot, Alan. Alan Nuckman, Chief Market Strategist of Bullseye Option, joining us, obviously with the theme of the day being